Brent, good to see you. I'm so glad we get to talk today. We are going to walk through 3 opportunities, financial planning and investment opportunities in a down market, which we are in. The US stock market saw the biggest 2-day wipeout recently in history, $6.6 trillion. In fact, the market has lost $11 trillion since inauguration day. And before we get into how to take advantage of it, I do want to talk through what we're seeing, which is something we've talked about before, the concentration risk in the market, where 80% of the market's movements due to only 10 stocks. And to see what that looks like in a different way, here's a look at the S&P's 3-month performance. The Mag 7 have lost $2 trillion since the start of the year. But Brent, when we see this much red on the board, what should we keep in mind?
Sure. To start, I'm glad you wanted to discuss this today because the volatility has everybody on edge.
Yeah.
But if you look at it through the lens of an opportunity, there are things that can be done. So thanks for bringing it up. But what this chart explains, essentially in one nice snapshot, is the S&P 500 is not a diversified portfolio. So you got 500 companies in there, and you've got 7 to 10 that make it or break it. And what that means is we enjoyed some phenomenal gains in 23 and 24. And then what's happening? It's the opposite. Those same companies are absolutely nosediving in 2025. So portfolio design is important. You can't just throw it in the S&P and hope for the best because you're going to end up with some roller coaster rides.
All right, so now let's talk how to take advantage of this down market. Number 1, put your cash to work. It may feel better to hide all your cash under the mattress right now, but it really does compromise your ability to build wealth. This top blue mountain shows the S&P. The middle blue line there is bonds, and that black line, that flat line at the bottom, that's T-bills, essentially cash.
Yeah, so what you're seeing here is being invested over the long run is actually a lot safer than holding cash.
Yeah.
So most of our clients, they are either retired or about to be retired. And so they're not doing the consistent investing anymore, but many do have cash on hand. And so it's not a bad time that even though things feel shaky, once we see these 10, 15% pullbacks, throw a little bit more money in there. Because so far to date, the market has always recovered. And so when that bounces back, you took your cash that was earning very minimal, and then you're riding that roller coaster up. For our younger clients who are consistently investing, absolutely stay the course. This is the best time for those to come in because you're buying cheaper shares.
Right.
And it never fails, or at least I have one friend or a client say, hey, things are pretty hairy. Should I stop investing for a while? And I'm like, no, do not touch it. This is exactly what we expected.
I'm sure a lot of people are walking in though too saying, all right, let's buy this dip.
You got it.
So let's now talk about taking advantage of our stock losses. This would be tax loss harvesting. Can you walk through how this works, please?
Sure. So let's say you have some gains in a after-tax account like a brokerage, and then all of a sudden we have some big pullbacks like this. You can offset those gains, which would be taxable, by selling some of your other positions that have a loss. And so this is going to give you a little reprieve on your tax bill at the end of the year. There are some rules involved, like the wash sale rule. I won't go into the nitty-gritty detail, but you need a strategy to do this where you can essentially lower your taxes a little bit. And who doesn't want to pay a little less taxes if you're feeling the pain, from the stock market?
Yeah, no, I love being able to talk through these silver linings. Last, can you explain why a Roth conversion makes more sense in a down market?
Yeah, so we are always challenging our clients to be bold. And so when the market is being, the way it has been and showing a lot of volatility, they're already concerned. But we're reaching out and we're saying, hey, this is actually an opportunity. These shares have depreciated greatly in your pre-tax account. Let's flip those over to a Roth account, pay the taxes on that depreciated amount, and then ride the wave back up in the Roth. You're never going to have to pay the government again on that. And just the benefits can be absolutely huge. And so being open-minded to doing some financial moves when the market pulls back, like a Roth conversion, can really benefit clients.
Right, absolutely. I like that. Be bold. Well, Brent, if somebody would like to talk through these strategies with you more in depth, how can they get a hold of you?
Sure. They can call the office, 614-430-8383. Megan can get you on the calendar, or go to young-wm.com. We would love to talk about it.
Great. Brent, thank you.
Thanks.